miezi 3 ikipita, njoo at least ikuwa nimesave at least fare ya kwenda na kurudi na ile na za matumizi kwanza nyumbani.
Interesting to know that there are some developments that need to be done in the country, but what's the magic solution to this? Well, Heri Homes is a real estate brand under Leo Capital Holdings Limited, which is a company that develops quality and affordable housing units to the discerning markets using an equity model, and is one of the leading real estate companies in Kenya, having its presence in several counties such as Nairobi, Mombasa, Kiambu, Machakos, Kajiado, Nakuru, among others. Heri Homes CEO Kimani Kimotho is joining us. Many thanks for being here with us this afternoon.
Yeah, thank you. Thank you.
And just to pick up from that clip, we are seeing the World Bank is concerned that the urban poor will continue to live in homes that are not decent and conducive. Perhaps where is the mismatch between the units being actually developed by people like you and many other developers, as well as the affordability of these units?
I think the biggest challenge has been the high cost of interest. That is what has made houses be a bit more expensive. And because of that, as Heri Homes, what we've done, we came up with the equity concept. This equity concept is what I'd ordinarily say is more like an unstructured real estate investment trust. So in Kenya, we've had like 2 companies which have tried to float some, a D-REIT and an I-REIT. So that's basically what you're doing under the equity model. So under the equity model, we've been able to bring down the cost of interest. And by bringing down, eliminate the cost of interest. And by eliminating the cost of interest, we've been able to offer affordable housing.
All right.
Yeah.
And speaking about the equity model, of course, many people might still struggle to understand it because, of course, we remember there was the real estate investment trust that was floated by Stanley, and it's also one of the key areas that many elitist kind of home owners would like to buy into. So how do you target that average Kenyan who would love to own a home using this equity model? Just break it down further for us.
Okay. The equity model mainly has 4 partners, 4 categories of equity partners. One is the shareholders. Shareholders, these are the people who come initially and together and acquire the piece of land. Then later, they also go ahead and do the feasibility study of the particular piece of land. Then from there, they equally go ahead and develop the plans. So at that level, that's where the shareholders' work ends. Then from there, they're able to attract people we call the development partners. Development partners, these are people who come and join you in before you break ground in a project. Just to give you an example, in one of our projects, for example, giving a project that would cost you ordinarily 150 million, when you go to a bank, the bank will tell you need first of all to raise 20%, which is around 30 million. For us to be able to finance you the balance, which is around 120 million. So to us, instead of going to the bank, we go to now the people we call the development partners. And development partners is someone like you or me who is willing to take a risk because he comes in before we break ground in a particular project. He basically buys a vision, but at that time we acquire the land. So on these development partners, they actually come and get the piece of the house at cost. Basically, after doing our BQ, we give them the cost of the BQ. Like in this scenario, the project which is worth 150 million, it has 60 units. So if you divide 150 by 6 units, you get approximately 2.5. So we'll be able to give these people, development partners, a unit at 2.5.
All right.
Without charging them anything.
And I know you have an event coming up over the weekend, but how has the uptake been in the Kenyan market where many people are skeptical about owning a house using such models like the mortgages? We know in the country currently have less than 30,000 mortgages. How do you convince people to buy into this? And of course, what are the trends looking like in terms of purchases?
Oh, interestingly, we've been able to attract quite a number of people because what happens in the model, by virtue of the fact that it brings the cost of the house down, then also the return on investment is also high. So because of the return on investment, realize that most of the people actually come into us because of return on investment. Return on investment is equally very high. So when we look at mortgages, I know the penetration in Kenya has been a bit low, but that is because when you do your maths, mostly at times you find that the cash outflows vis-a-vis the value of the house, even after completion, is actually negative. You find that you might even have paid much more than the value of the house after the 15 years. But in our model, you realize that the payback period, within a period of 5 years, 7 years, you have your money back, plus that time, the house has actually doubled. Like in the case scenario of the house you're giving over the weekend, those who came in as development partners got it at 2.6, but right now, anyone willing to sell is selling it at 5.2. So it's actually 100%, which actually goes further and beats even the issue of inflation rate. And that's why you find there are quite a number of uptakers. Plus, again, the payment plan is quite easy and simple, because the 2.6 is no money you give at once. So you don't actually even have to go and take a loan. You can actually use your savings to cumulatively to pay us. Yeah.
And maybe, Kimani, just to take you back to one of the points you raised, that one of the things that has made home ownership pipe dream for many Kenyans is the high interest. We did see the rates being capped at 14%, and this was sort of government action trying to stimulate credit uptake and, of course, open up more people to be able to access financial products to take up such like initiatives where you guys are in. But looking at the broader picture, the government also indicated that in the last budget that developers doing 1,000 units plus might face some tax holidays. And how feasible is this? And do you know of people who are already going big on this?
Like us guys, last year, our company, we did 400 units. So we are trying to see whether we can apply for that. So practically at the moment, yeah, it's possible, it's practical. That's a very good incentive, because now if you're doing over 400 units, actually they reduce it to 400 units. If you're doing over 400 units, you can easily get a tax incentive. You pay your taxes at 15%. That's a good incentive, but I think the government can still do more by probably even giving more tax rebates, especially in situation whereby we've even done infrastructure, because you find a situation at times developers actually end up even improving on the infrastructure to make the pieces of land a bit accessible. So if they could also give rebates towards such, that will still further enhance that.
So you're saying it's practical, but why are many developers shying away?
One, because also doing 400 units is equally not an easy task, and especially if you're using the debt model, it's not an easy task. So even if they lower the units, probably to 100, will still be better.
All right.
Yeah.
And maybe as we wrap it up, what sort of trends are we likely to see now that interest rates are capped at 14%? Are we likely to experience an uptake, high uptake really, in the property market? And of course, you're also going into an election period.
Okay. With the interest rates being capped, the flip side of it was the banks also tightened their rules. And real estate is one of the industries that the banks consider as a risk.
Everyone is saying banks tighten the rules. What are these rules that they have tightened?
Probably
what has changed?
The credit, the evaluations in the evaluation criteria has changed. Maybe the points you earn for you to qualify for a loan. And many people for a long time, the banks have considered real estate development a risky area, because whatever happens, whenever interest rates go up, many people who had taken the projects, especially when they're doing off-plan, actually end up dropping. As a result, most of the developers are unable to pay. So we end up having a lot of backlogs of bad debts. So, but for us, it is actually working to the positive. Because what is happening is that now most of the clients who are buying with us, some even if as we're not taking loans, we're using an equity model, they can easily now be able to uptake those loans at a lower interest rate.
All right.
And that way they can come and invest with us. So we are working on a scenario whereby we can be able to pull investors around who are investing in our projects to actually take the loans and invest with us. So to them, now that the interest rate is low, their cost of money is much less, and that's why they're willing to take a risk. And when they compare with the returns we are giving them in our houses, because most of our houses give you a return of 16%.
All right.
So they can easily take a risk and take a loan of 14% and still have at least 2% profit for the time when they're paying the loan.
And being someone interested in real estate at a personal level, perhaps where are we seeing more developments going towards? Because Nairobi is densely populated, and the satellite towns have been growing as well, the likes of Kitengela, Kiserian, and Ruiru, Juja. I mean, which areas are developers considering to go now that land in Nairobi is exorbitantly expensive?
For the time being, you'll still find people wanting to stay around Nairobi. Reason being, 70% of the economy is still being controlled around Nairobi. So that's where you find most of the people get their earning from. So still, most of them will still want to be hung around Nairobi. That's why you find now the uptake of apartments has become the in thing. The other day you saw an article, 75% of the houses sold in the first quarter, actually all of them have been apartments. So the trend is moving more towards people owning apartments, because still people want to be near Nairobi. And so because of the scarcity of land and the high cost of land, to bring that down maybe...
And the due diligence you might have to take
before you acquire a piece of land.
Yeah.
Or before you acquire property.
Before you acquire a piece of land.
Yeah, due diligence is actually a very fundamental key, and that's one thing that we always advise our clients to do. The first thing, like for us, if you're buying a property, it may be very important for you. Of course, do the normal search. Know who are the owners of the property, who are the people behind it. That is, you also do a CR12 search. Then over and above that, you can also ask a developer to show you the approved plans. Because no developer will actually, no one will give you an approved plan if you don't have the requisite papers. So some of the documents we should ask. They put a number of lists, like 10, maybe that's I will give you at this time. So those are some of the things that any potential buyer should be asking a developer.
Okay.
Yeah.
Many thanks, Kimani Kimotho, Chief Executive Officer, Heri Homes, talking to us, leading to that interesting conversation around what can Kenya do to make the cost of housing affordable for many Kenyans,